Hi, everyone. Welcome to our year-end market update. Looking back at 2025, it was a strong year for investors, but also a more complicated one beneath the surface. Today, we'll walk through what drove markets last year, what we're seeing in the economy, and how we're thinking about the road ahead. Let's start with the big picture. Global markets delivered an outstanding year in 2025. Stocks posted strong returns across nearly all regions, with international markets leading the way. U.S. stocks also had a solid year, with the S&P 500 up around 18%. Fixed income was another bright spot, returning around 7%. Despite these strong results, the economic backdrop became more complex throughout the year. Trade policy uncertainty, a federal government shutdown, and geopolitical events throughout the year all impacted growth. Looking at the economy, growth in 2025 was uneven, with shifts from quarter to quarter shaped by policy changes, adjustments to government spending priorities, and rapid investments in AI. Overall, GDP growth for the year is expected to come in at just under 2%. Turning to the labor markets, unemployment recently ticked up to about 4.6%. Job growth has slowed, but that's largely been offset by a lower labor supply due to reduced immigration. Inflation has been difficult to get a handle on lately due to delays in government data. Most recently, inflation measured about 2.7% as of November. Global equities returned about 22% last year, with international stocks clearly leading the way. International markets outperformed U.S. stocks by roughly 14.5%. A weaker dollar account for about 8% of that outperformance for U.S.-based investors. Beyond currency effects, international stocks also started the year at lower valuations, benefited from easy monetary policy abroad, and saw increased allocations from global investors. Here in the U.S., performance was still strong. The S&P 500 finished the year up 18%, including a 40% rebound from the market lows in April. Market leadership broadened out in 2025. For the first time in several years, the 10 largest stocks account for less than half of large cap returns, a healthy sign for diversification. That said, after 3 years of strong gains, stock valuations are elevated relative to historical levels. While valuations are not a reliable short-term timing tool, they do increase the risk of volatility if earnings disappoint or the economy encounters a slowdown. At the same time, there are structural reasons why stocks may trade at higher valuations than in the past. These include lower trading costs, lower tax rates, and higher profit margins driven by more scalable, asset-light business models. After a stretch of muted returns from 2013 through 2022, bonds have now delivered several consecutive years of solid performance. In 2025, fixed income markets returned about 7%. Falling interest rates, especially in the 1 to 10 year part of the yield curve, helped drive price gains, while starting yields around 5% provide attractive income. Longer-term interest rates remain more stable, as concerns around fiscal spending and longer-term inflation supported yield levels. Even though credit spreads have tightened, high-quality fixed income continues to offer compelling yields and plays an important role in providing stability and income within a diversified portfolio. Looking back, 2025 was a strong year for investors. Markets delivered solid returns across asset classes, despite ongoing concerns around trade policy, geopolitics, and economic uncertainty. Diversification once again proved its value, with international stocks and bonds helping support portfolios during periods of U.S. market volatility. Investors who stayed disciplined throughout market swings were rewarded with meaningful gains. Looking ahead to 2026, there are still open questions around the impact of trade policy, tax law changes, interest rates, and the pace of AI investment. While solid earnings growth is expected to continue, elevated valuations could cause markets to be more sensitive to economic surprises. Bond yields remain attractive and continue to offer both income and potential downside protection. During times like this, we remain focused on the consistent implementation of the long-term plans we've built for our clients. We believe that discipline, diversification, and staying aligned with long-term goals are what ultimately drives successful outcomes over time. Thank you for watching our year-end market update. We appreciate your continued trust, and we look forward to keeping you informed in the year ahead.